The journey toward financial mastery does not begin in a bank or on a trading floor. It begins within the corridors of the human mind. To understand money, one must first understand that it is not a physical object, but a collective hallucination, a social contract of value that allows strangers to cooperate. For centuries, humanity traded shells, gold, and paper, but the underlying mechanism was always trust. In the modern era, this trust has been digitized, yet the primal instincts that govern our relationship with resources remain unchanged. The first pillar of financial management is the deconstruction of the scarcity mindset. Most individuals view money through the lens of survival, seeing it as a finite resource that must be hoarded or spent immediately to satisfy biological urges. However, the wealthy view money as a tool of leverage, an employee that works 24 hours a day without rest. This fundamental shift in perspective is the prerequisite for everything that follows. Without a disciplined psychological foundation, even $1 million windfall will eventually evaporate. We see this in the lottery curse, where those who gain sudden wealth without the mental infrastructure to support it return to poverty within years. The reason is simple. Wealth is not what you have, but what you are. It is the sum of your habits, your delayed gratification, and your ability to calculate risk versus reward. To build the foundation of capital, one must master the art of the gap. The gap is the space between your income and your expenses. In a consumerist society designed to separate you from your capital, maintaining this gap is a rebellious act. Marketing psychology is engineered to trigger the dopamine receptors in our brains, making us believe that a new car or a designer watch is a necessity for social signaling. True financial management requires the shedding of the need for external validation. When you stop buying things to impress people you don't like with money you don't have, you begin the process of true capital accumulation. The second layer of this foundation is the understanding of the time value of money. $1 today is worth more than $1 tomorrow, not just because of inflation, but because of its potential to earn interest. This concept is the heartbeat of capitalism. If you spend $1 today on a coffee, you aren't just losing $4. You are losing the thousands of dollars that $4 could have become over 40 years of compounding. This realization should not lead to a life of misery and deprivation, but to a life of intentionality. It is the difference between being a consumer and being an owner. Every time you purchase a stock, a piece of real estate, or a business interest, you are moving from the side of the table that pays to the side of the table that collects. As we move deeper into the mechanics of money management, we must address the invisible tax of inflation. In a fiat currency system, the purchasing power of your savings is constantly being eroded by the expansion of the money supply. Therefore, saving in the traditional sense is actually a losing strategy. Cash is a melting ice cube. To preserve wealth, one must convert cash into productive assets. This leads us to the concept of the velocity of money. How quickly your capital can move from one investment to the next to generate a return. The goal of part one of this journey is to move from a state of financial unconsciousness, where money happens to you, to a state of financial awareness, where you are the architect of your own economic ecosystem. Furthermore, we must analyze the role of human capital. Before you have money to invest, you have your time, your skills, and your energy. Your ability to earn is your greatest asset. Investing in yourself, learning high-value skills like sales, coding, leadership, or technical analysis, provides a return on investment that no stock market can match. If you increase your earning capacity by 20, that is a permanent raise in the baseline of your life's potential. This is the seed capital phase. You are the farm, and your skills are the seeds. Only once the harvest is consistent can you begin to build the silos of investment that we will explore in the subsequent chapters of this documentary. The transition from labor-based income to asset-based income is the ultimate goal of the financial journey. It is the transition from trading your limited hours for dollars to having your dollars trade their hours for you. The transition from a saver to an investor marks the most significant evolution in a person's financial life. If part one was about clearing the mental brush and establishing a baseline of discipline, part two is about understanding the engine of the global economy, the stock market, and the relentless force of compounding. To the uninitiated, The stock market looks like a chaotic casino, a flashing board of red and green numbers where fortunes are won and lost on the whim of a news cycle. But to the architect of wealth, the market is a weighing machine of human progress. When you buy a share of a company, you are not betting on a ticker symbol. You are buying a claim on the future labor, innovation, and intellectual property of thousands of employees. You are becoming a silent partner in the global engine of productivity. At the center of this engine is the concept that Albert Einstein reportedly called the eighth wonder of the world: compounding. Compounding is the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. It is a mathematical snowball effect. In the early years, compounding is frustratingly slow. You may save diligently for 5 years and see only modest gains, leading many to abandon their strategy in favor of get-rich-quick schemes. This is the valley of disappointment. However, compounding is exponential, not linear. The true magic happens in the final third of the timeline. A person who starts investing $500 a month at age 20 will have significantly more wealth by age 60 than someone who starts at age 30, even if the second person invests double the amount. This is because the first person gave their snowball an extra decade to roll down the hill. Time, not timing, is the most powerful variable in the wealth equation. To harness compounding, one must understand the anatomy of the stock market. The market exists to solve a fundamental problem. Companies need capital to grow, and individuals need a place to grow their savings. By issuing stock, a company raises money to build factories, develop software, or expand into new countries. In exchange, the investor receives a piece of the ownership. Over long horizons, the stock market has historically returned an average of 7 to 10 annually after inflation. While this may not sound like much in a world of crypto volatility, a 7 return doubles your money every 10 years. In 30 years, your initial capital has doubled 3 times, meaning it is 8 times its original size. This is how the middle class transforms into the wealthy class, not through a single lucky break, but through the consistent application of mathematical reality. However, the path of compounding is rarely a straight line. It is interrupted by the market cycle. The market is driven by 2 primary emotions: fear and greed. During a bull market, optimism is high, prices rise, and everyone feels like a genius. This is the period of greatest risk, as high prices often decouple from actual value. Conversely, during a bear market, fear takes hold. The media reports on the death of capitalism, and investors panic sell their assets at a discount. The master of money management understands that price and value are not the same thing. Price is what you pay. Value is what you get. A market crash is simply the world's greatest department store putting all its best merchandise on a 30 sale. Those who have the psychological fortitude to buy when others are fearful are the ones who accelerate their compounding journey by decades. This leads us to the critical distinction between speculation and investment. Speculation is the act of trying to guess the short-term movement of a price. It is a zero-sum game played against high-frequency trading algorithms and Wall Street insiders. Investment, on the other hand, is the long-term ownership of productive assets. To be a successful investor, you do not need to be a mathematician. You need to be a philosopher of risk. You must practice asset allocation, the art of spreading your capital across different buckets, such as domestic stocks, international markets, bonds, and real estate. This diversification ensures that while one sector may be underperforming, another is thriving. It is the only free lunch in finance, as it reduces your risk without necessarily reducing your expected return. As we look deeper into the mechanics of growth, we must address the role of dividends. Dividends are a portion of a company's profit paid out to shareholders. For the long-term architect, dividends are the fuel for the compounding engine. By opting for dividend reinvestment, you use those payments to buy even more shares, which in turn produce even more dividends. Over a 20-year period, reinvested dividends can account for nearly half of the total return of the stock market. This creates a feedback loop of wealth that eventually becomes self-sustaining. There comes a point in the journey, the crossover point, where the growth and dividends from your investments exceed your monthly cost of living. This is the technical definition of financial freedom. At this stage, work becomes optional, and your time is finally your own. Understanding the stock market also requires an understanding of index funds versus active management. For decades, the financial industry convinced the public that they needed experts to pick winning stocks for them. However, data has shown that the vast majority of professional fund managers fail to beat the market average over the long term, especially after accounting for their high fees. The rise of the index fund, popularized by John Bogle, changed everything. An index fund allows you to own a tiny piece of every major company in the market simultaneously for almost zero cost. By buying the haystack, instead of searching for the needle, the average person can outperform the majority of professionals. This democratization of finance has moved the power from the ivory towers of Manhattan to the kitchen tables of everyday people. Finally, we must discuss the volatility tax. Volatility is the price of admission for the returns the market provides. If the stock market went up by exactly 0.03 every single day, everyone would be an investor and the returns would be driven down to zero. The high returns exist because the market is bumpy. Most people fail because they treat volatility as a signal to act, rather than a noise to be ignored. They see a 10 drop in their portfolio and interpret it as a loss of real money, forgetting that a loss is only realized if you sell. The true investor views their portfolio not as a balance in a bank account, but as a collection of productive farms. If the price of farmland drops tomorrow, the farmer does not sell the farm in a panic. He looks at the crops. As long as the companies you own are still producing goods and services that the world needs, the temporary fluctuation in their price is irrelevant to your long-term success. Moving from the engine of growth to the architecture of security, this is the third 3,000-word installment of your documentary series. This section focuses on defending the capital you have built and using leverage as a surgical tool rather than a blunt instrument. Part 3. The fortress of protection and debt leverage. If the first half of the financial journey is a game of offense, earning, saving, and investing, the second half is a rigorous game of defense. History is littered with the stories of individuals who built massive empires only to watch them crumble due to a single lawsuit, a change in tax law, or the corrosive effects of predatory debt. Building wealth is a skill, but keeping wealth is a discipline. To protect what you have built, you must transition from being an investor to being a risk manager. This phase of the journey is about building a fortress around your assets, ensuring that no matter what happens in the external world, be it a market crash, a legal dispute, or a global economic shift, your foundation remains unshakable. The first wall of this fortress is the sophisticated understanding of debt. In the world of personal finance, debt is often treated as a binary, either a tool for growth or a path to ruin. To the sophisticated money manager, debt is simply leverage. There is a fundamental distinction between consumer debt and investment debt. Consumer debt is a parasite. It is the act of borrowing from your future self to fund a lifestyle your current self cannot afford. When you carry a balance on a credit card at 20 interest, you are engaging in reverse compounding. You are feeding the bank's engine of growth while starving your own. This is bad debt, and it is the single greatest obstacle to financial freedom. However, good debt is the strategic use of borrowed capital to acquire an asset that produces a higher return than the cost of the interest. This is how the wealthy scale their operations. By using a mortgage to buy real estate or a business loan to expand production, you are using other people's money to accelerate your own compounding. The key is the spread, the difference between the cost of the debt and the yield of the asset. Mastery of Part 3 requires the surgical ability to eliminate the parasitic debt while prudently managing the productive leverage. The second wall of the fortress is tax strategy. Taxes are likely the single largest expense you will face in your lifetime, often taking 30 to 50 of your total lifetime earnings before you ever see a dime. Many people view taxes as an inevitability, but the tax code is not just a list of costs. It is a series of incentives. Governments use tax laws to encourage behaviors that benefit the economy, such as investing in housing, creating jobs, or funding retirement accounts. By aligning your financial behavior with these incentives, you can legally and ethically reduce your tax burden. This is the difference between tax evasion, which is illegal, and tax avoidance, which is a hallmark of the financially literate. Utilizing tax-advantaged accounts like IRAs, 401ks, or insurance wrappers allows your investments to grow in a protected environment, shielded from the annual friction of capital gains taxes. Over 30 years, the difference between a taxed account and a tax-deferred account can result in a portfolio that is nearly double in size. The third wall of the fortress is asset protection. We live in a litigious society where success often makes you a target. Protecting your wealth means ensuring that your personal liability is separated from your capital. This is why the concept of the legal entity exists. By holding assets within limited liability companies, LLCs, trusts, or foundations, you create a barrier between yourself and potential creditors. If a business venture fails or a legal dispute arises, the corporate veil ensures that your home, your retirement savings, and your family's future are not at risk. Furthermore, wealth protection involves the strategic use of insurance, not as a lottery ticket, but as a hedge against catastrophic risk. You do not insure against the small things you can afford to pay for. You insure against the black swan, events that would otherwise reset your financial clock to zero. Beyond legalities, the fortress must be protected from the silent thief, inflation. As we touched upon in the earlier segments, currency is a medium of exchange, not a store of value. When a government prints money, the purchasing power of every dollar in your pocket decreases. To defend against this, your fortress must be built with inflation-hedged assets. These are things that have intrinsic value that cannot be printed: real estate, gold, silver, Bitcoin, and ownership in companies with pricing power. A company with pricing power can raise its prices when its costs go up, effectively passing the burden of inflation onto the consumer while protecting the shareholders' profit margin. Your goal is to move your wealth out of nominal assets, cash, and into real assets that maintain their value relative to the cost of living. Finally, we must address the internal threat to the fortress: lifestyle creep. As your income and investments grow, the temptation to upgrade your life is immense. This is often referred to as the hedonic treadmill. You buy a bigger house, a faster car, and more expensive vacations, only to find that your level of happiness remains the same while your financial independence number moves further away. To protect your wealth, you must maintain a standard of living that is intentionally lower than your standard of earning. This creates a buffer, a margin of safety, that allows you to survive lean years without liquidating your long-term investments. True wealth is not about what you spend. It is about the autonomy you have over your time. Every luxury purchase is a trade-off against a piece of your future freedom. The final stage of financial mastery is the transition from rich to wealthy. While being rich is measured in the currency of the present, what you can buy, where you can live, and what you can consume, true wealth is measured in the currency of time and generations. Most people spend their lives building a sandcastle, only to watch the tide of time wash it away within 1 or 2 generations of their passing. There is a common adage in sociology: shirt sleeves to shirt sleeves in 3 generations. The first generation builds the wealth through grit and sacrifice. The second generation manages it but loses the hunger. And the third generation, having never known the cost of a dollar, squanders it. To break this cycle, the architect of wealth must realize that the most important asset they will ever transfer is not money, but the intellectual capital and values required to manage it. Generational transfer begins with the concept of the family bank, or the private trust. Instead of simply leaving a lump sum of money to heirs, which often acts as a wealth accelerant to their vices, the sophisticated manager creates a structure. This structure is designed to foster productive behavior rather than dependency. Wealth should be a floor, not a ceiling. It should provide the foundation for descendants to pursue education, entrepreneurship, and philanthropy, rather than a life of leisure that leads to stagnation. By creating a trust with specific incentive clauses, you ensure that the capital is used to empower the next generation. For example, a trust might match the earned income of a beneficiary or provide seed capital for a business, provided a viable business plan is presented. This transforms the inheritance from a handout into a hand-up, preserving the ambition that created the wealth in the first place. Education is the second pillar of legacy. Financial literacy is rarely taught in schools, and in many wealthy families, money is a taboo subject. This silence is dangerous. To preserve a legacy, the next generation must be readied for the money, just as much as the money is readied for them. This involves involving children in age-appropriate financial discussions, teaching them the mechanics of compounding early, and exposing them to the realities of risk and loss. It is about shifting their identity from consumers of family wealth to stewards of family legacy. When a child understands that they are a link in a chain that stretches back before them and will continue after them, they are far less likely to make impulsive decisions that jeopardize the collective's future. Beyond the family, the legacy of wealth must address social capital and philanthropy. There is a point of diminishing returns in the accumulation of personal assets where an extra $1 million adds nothing to your quality of life, but could fundamentally transform a community or a cause. True financial mastery culminates in the realization that wealth is a responsibility. Philanthropy is not just about writing checks, it is about strategic impact. By applying the same rigorous investment principles to giving as you did to earning, you can solve systemic problems. Whether it is funding scholarships, supporting medical research, or investing in sustainable infrastructure, philanthropy allows your capital to live on through the lives of people you will never meet. This is the ultimate return on investment, the ability to influence the world long after you have left it. We must also discuss the technicalities of estate planning. Without a clear, legal roadmap, a significant portion of your life's work can be lost to probate courts, legal fees, and estate taxes. A well-constructed estate plan is the final blueprint of the architect. It includes wills, powers of attorney, and healthcare directives. But more importantly, it includes a letter of wishes. This is a non-legal document where you explain the why behind the what. It is where you communicate your philosophy, your mistakes, and your hopes for the future. It is the human element that breathes life into the cold legal documents. It ensures that your voice remains the guiding hand of the fortress you built. Furthermore, a legacy requires a transition of leadership. Just as a CEO must eventually step down, the head of a family's finances must mentor a successor. This is often the hardest part for the wealth builder, as it requires letting go of control. However, a forced transition, one caused by death or incapacity, is always more chaotic than a planned one. By gradually delegating investment decisions and philanthropic choices to the next generation while you are still present to guide them, you allow them to make small mistakes so they are equipped to avoid big mistakes later. This mentorship is the final act of stewardship. Finally, we must reflect on the soul of money. Throughout this 4-part documentary, we have discussed math, markets, taxes, and law. But money is ultimately a mirror. It amplifies who you already are. If you are anxious, more money will make you more anxious. If you are greedy, more money will make you greedier. But if you are purposeful, disciplined, and generous, money becomes the magnifying glass for those virtues. The ultimate goal of financial management is not to die with the largest number in a bank account. It is to live a life characterized by financial peace. This is the state where money is no longer a source of stress, but a silent, reliable servant that allows you to focus on what truly matters: your health, your relationships, and your contribution to the world. In the end, the architecture of wealth is about freedom. It is the freedom to say no to things that drain your spirit and yes to things that fulfill your purpose. It is the freedom to protect your family, to support your community, and to leave the world slightly better than you found it.